What's up, YouTube? In this video, we're talking about Intuit, ticker symbol INTU. Year to date, company is up 29.5%. Over the course of 1 year, is up 26.3%. Intuit does offer a little bit of a yield for you and is currently trading, well, forward looking at a 30.9 PE. Intuit doesn't report earnings for another, about a month from now yet. And it looks like EPS revisions over here on this company is a little bit of a mixed bag. You got 9 up and 10 down. So a little bit of some confusion and uncertainty at Intuit currently is to where its earnings might end up. So we're going to go through Intuit's financials here and figure out how this company is doing financially, place Intuit against a couple competitors, and then after that we'll look through some valuation metrics and figure out what Intuit might be worth. So at the financials here, we have our revenue, gross profit, net income chart right here. Revenue, gross profit are doing very good. Net income on its own chart here looks pretty good. It's trending higher. So that's always obviously good. But obviously their revenue and gross profit is growing substantially. You'd like to think their net income would kind of join the pack, but it just really isn't growing. Gross margins are declining overall. It used to be 85%, now sitting at 78%. Net margins relatively flat, but kind of near their lows, really. I mean, they used to be, low to mid 20s there. There's a good 5-6% of net margin that's been cut off. Growth rate on revenue and gross profit starting to trend lower here, but more in line with where it kind of used to be at about a little bit 10-12% range. Looking like that's about where it's going to end up. Uh, Looking like that's where it's ending up right now. Return on invested capital. Man, some of these metrics on this company I'm just not liking right off the bat. We can see our return on invested capital just trending lower. Uh, very quickly down to 10%. Really would like to see this stabilize at least 20-30% range. I mean, if it's done it before, I think it can do it again. Here's the thing though, here's the catch. PE is at 60 and we've got decreasing margins and increasing revenues, decreasing return on invested capital. So I'm not a big fan of these financials over here, and they're not really getting any better. So our cash to short-term debt, pretty good. We got enough cash to cover our short-term debts, just barely a little more debt than cash, but depending on what all those liabilities could be. Cash to total debt, though, I mean, for some reason, this company just exploded in debt, and now they used to be like, if this is where the chart was at, where they had more cash than total debt, total liabilities, that'd be fantastic, but that is not the case. They've got almost $11 billion in debt and $3.6 billion in cash. Net to free cash or net income to free cash flow. So they have a tremendously large amount of free cash flow, more than their net income. For me, that is always not what I like to see, and it's always been like that too. It hasn't really slowed down, but we can see here's why. Look at that stock-based compensation. Their stock-based compensation is almost as much as their net income. And although they are buying back the majority of those shares and actually a little bit more than what they're paying out. But that's what's causing their free cash flows to look so good when really they're not as good as what they're showing right here. Yeah, $4.8 billion, but take away $1.7 billion of that, and now you're left with $3 billion. You do that a few more times going back into history here, and it really, I mean, they're good. They're still positive free cash flow, but not as good as what they're showing. So that's one thing that I always look a little bit deeper into and figure out exactly why we're producing more free cash flow than what net income is. Usually it's going to be stock-based compensation, a little bit of depreciation there as well. So we can see our share count. We're not getting diluted, but it is not declining either. Dividend though, they do have a good track record of increasing their dividends. So as a dividend investor, that would be something you always would like to see. Capital expenditures staying pretty flat at about $260 million. So pretty good there. So overall financials, not great, not bad. There's a few things in here that I really am not very impressed with, especially if you're going to be trading at a 60 PE. I don't know. That's my opinion. So I pulled up their most recent earnings statement here, and we can see their long-term debt has, that was one of the big things we saw was their debt was increased by quite a bit. So they got about $6 billion of long-term debt. Now, one thing that could be potentially important, it depends on what kind of debt that is, right? If it's locked in at a certain rate, maybe it's got a balloon of 5 years or 10 years or something like that, and they're only just paying interest and then just paying down the debt as they can. It just depends on what kind of a loan that could be or whatever kind of debt that is. But we can see that last year they only paid $81 million in interest expense. This year so far they've paid $248 million in interest expense, and they've also paid down some of that debt. So I'm wondering if that might not be a little bit of a variable rate interest rate. So obviously with the increase in interest rates, that's going to impact their interest expense, which will then impact their net income as well. So because of borrowing that more debt or borrowing $6 billion more in debt for whatever reason, they must have a project, or maybe they needed to buy a company, they have done acquisitions in the past. Maybe that's what they used it for. I have not looked into it to understand exactly what it was from, but it will cost more in interest expense, again, depending on what kind of a debt it is. Also, on the cash flows, so up here we can see we're on the cash flow statement. Here's our net income. Here's that incredibly large amount of stock-based compensation. And you add those, basically you just add those two together and you almost get your net cash provided by operating activities because of how much stock-based compensation they're handing out. But then we do scroll down. So that's going to make their cash flows look really good. So you take that cash from operations minus off their CapEx, which is pretty nominal. It gives them a free cash flow of $4.8 billion per year. And then down here, we can see they've paid back about almost $2 billion in their share count. So basically what they're handing out, they're buying back. So it's almost a zero anyway, but it's just making their cash flows look really good. So over here at the comps, I've got these two other companies to compare Intuit with. We have 3 red flags on Intuit. We have return on invested capital, which we've already gone over. And also down here, our operating cash flow is significantly higher than our net income also has already been gone through. Market cap on the board and revenue, Intuit, lowest on market cap and revenue. Revenue, gross profit, net income, kind of same thing. You can see where Intuit is compared to the competition. Growth rate, looking like 31 to 13%. Revenue on 13%, 31 EPS growth rate. So, and then that's for the next 5 years. So growth rate's looking pretty decent, but I think it's gonna be a little bit challenging for the company to grow into a 60 PE. I mean, the growth rate's not quite, it's gonna be, and that's over the course of 5 years too. So it's a little hard to predict a 5-year growth rate overall anyway, but that is what our average growth rate is on the EPS and revenue. Margins across the board, pretty good margins on Intuit. Operating margin could be better. We've seen it better. Profit margin, same thing, could be a lot better, and we have seen it a lot better. So maybe if they can kind of get those margins back a little bit, I think that would make this company a lot more valuable to investors. Free cash flow, again, we already kind of went through that free cash flow a little bit. It's not as good as what it appears to be. We can see the competition's got a little bit better free cash flows. Return on invested capital, again, we've seen it better, but it's shrunk up, it's shriveled up quite a bit. PE, we've got 60 PE on the company. We know that that is likely going to contribute and carry over to our valuation spreadsheet and tell us that company's probably overvalued right now. Over here at the P&L valuation, $356.64 per share. Multiples comparison, comparing to the companies that we just went over, that gives us a price per share of $240.87. We take our market cap minus cash, add in debt, divided by cash from operations. We get 29 years to earn our market cap, which tells us we are currently overvalued. Price to book, 5-year average 10.9, currently at 8.2. PEG ratio telling us we are very, 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 very richly valued, especially current on the current PEG. Forward-looking PEG, still a little richly valued, but getting a little closer, a little less richly valued. Grams valuation, $367 per share. Dividend discount model gives them $530.49 or 45 cents per share. Discounted cash flow valuation, analysts gave them an 18% growth rate. Their history is 24, so I met them in the middle at 21% growth rate. That gives them a DCF of 555, 66. Rule 72, we have three sources of an EPS growth rate for an average of 24. That would then go into 72, 2.98 times. That goes in 10 years, 3.35 times. So that would tell us we could double our EPS 3 times and a little bit more than that, which would give us a future EPS of around maybe 75 roughly. And that tells us our fair value is $905.63. I'm gonna not go with that number because it just seems to me like 35 seems more fair of a future EPS, especially since we're sitting at 8.4. I don't see how we're gonna 10x our EPS anytime real soon, especially with okay growth rates. Like we're sitting at 13% revenue and what was it, 31% EPS growth rate. I mean, yeah, there's growth, but it's gonna that growth is gonna slow down too. So I'm gonna keep it at 35. That's still about what 5-6 years before we hit that EPS. At the summary, Intuit is currently trading at $506.81. Fair market value we got $412.22. 30% margin of safety, $288.55. Analyst price target of $575.45. So over here on the stock chart for Intuit, we can see we are locked in this uptrend here now. We were in a big, pretty substantial downtrend, but since have regained some strength and now are in this uptrend. We have recently hit the top of, or at least confirmed a bit of a top of a channel here. And we, in the shorter term here, we were making significant higher lows and higher highs as well. But since now we have broken trend and is potentially likely where we might roll back over, and maybe we will see about 400-ish dollars per share in this company. We did just get it valued at 412. I don't think we'll see $289 per share in this company, but it is possible to see about mid to upper 400s potential, depending on where this ends up. If it retests this channel, we could see about 428 roughly, depending on how quickly it gets there. And that could be a good buying opportunity, especially if you're going to be a little bit more of a technical trader. That would probably be a great place to pick up shares on Intuit. And also down here, we can see the MACD starting to roll over, RSI is rolling over. We might see some pretty good selling pressure on Intuit in the future here, which would be good because that would give us an opportunity to potentially buy this company, a very good company. Financials aren't that great in my opinion. They could definitely be a lot better. But if you're going to trade on technicals, I think right about 425 to 430 range is probably a pretty good range to potentially pick up some shares. Um, Again, I don't think we'll see a $289 price tag on this company again, or at least anytime soon. If something happens, then that would be might be some more concerns behind the company that might be worth looking into. But overall, what I'm seeing on this chart is a potential rollover down to 420, 430 range, and then maybe a resumption higher to maintain this upward channel that it is currently locked in. But that is it for Intuit. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.